Can a company built on, the cutting edge of drones and enterprise software truly disrupt traditional industries, scale to profitability, and, well, ultimately fly high for investors? Today, we're diving deep into ZenaTech Inc., ticker ZENA, a company that really embodies that classic high-risk, high-reward investment opportunity. It's certainly not for the faint of heart, but for those who truly believe in management's ambitious vision, the potential for significant returns is definitely on the table. The big question we're tackling is whether ZenaTech can successfully transform itself from like a collection of small strategic acquisitions into a cohesive, profitable, and ultimately a market-leading enterprise. Welcome to the Deep Dive. Our mission today is to unearth the most important insights from an expert-level research report on ZenaTech, a fascinating high-growth tech company. We're basing this analysis on data current as of August 26, 2025, when Zena's closing share price was $4.94. We'll be navigating through 7 distinct chapters, breaking down everything you need to know about this intriguing player in the drone and enterprise software space. We've structured this deep dive into 2 main parts. First, we'll cover chapters 1 through 3, focusing on the business, management, and financials. Then, in part 2, we'll shift our focus to market sentiment, ownership, risk, and wrap it up with a concluding outlook. Let's get started. Okay, we're launching into part 1, beginning with chapter 1, business analysis. So, to start, tell us about ZenaTech's core identity. Headquartered in Toronto, Canada, founded back in 2017, they operate under, well, a rather unique dual business model. What's really at the heart of how they've blended these 2 distinct segments? What makes ZenaTech tick?
Well, ZenaTech's foundation is built on a portfolio of enterprise SaaS solutions. So think software as a service. This provides stable, recurring revenue from licensing and maintenance. It supports critical applications for law enforcement, government, industrial sectors, kind of a steady base. However, the real high-growth engine, the clear catalyst, is their drone as a service, or DS segment, operating through ZenaDrone. They develop and manufacture drones for commercial and defense uses, but crucially, they allow clients to access these advanced drone services without that significant overhead of ownership. What's particularly striking here is the pivot we saw in their Q2 2025 results. DS actually contributed $1.98 million.
Wow.
Yeah, significantly outpacing SaaS at $1.39 million. So DS is now the primary driver of their recent explosive growth.
That shift is really compelling, moving beyond just making drones to this drone as a service model. It's not just about selling hardware, it's about providing solutions, right? Can you give us a glimpse into their product suite? What's that overarching value proposition for their clients?
Absolutely. Their product lineup includes the versatile ZenaDrone 1000. It's designed for heavy lift applications like agriculture, critical cargo transport, even for the U.S. military. Then there's their IQ series. You've got the IQ Nano for like intricate indoor inventory management and the IQ Square for broader outdoor tasks. Their value proposition is, well, crystal clear. They're transforming often manual, labor-intensive workflows into scalable, tech-driven solutions. By leveraging AI drone hardware and software, they help clients achieve, and this is their quote, exceptional operational efficiencies, precision, and cost savings.
Okay, so if they're promising these efficiencies, what does this all mean for the broader industry they operate in? I mean, how big is this drone market and who are they actually up against in this increasingly crowded space?
It's incredibly dynamic. The drone industry is just experiencing massive growth. The global drone surveying market alone, projected to exceed $8 billion by 2030. That's a TAGR, compound annual growth rate, of maybe 15–20%. Huge numbers. Huge. And the military drone market. That's forecast to jump from $14 billion in 2023 to get that's $37 billion by 2032. These trends are really fueled by rapidly increasing government and commercial adoption. So ZenaTech finds itself competing with, well, diversified players like Bandwidth and Perion Network on the software side, but also with established defense drone giants, AeroVironment and Kratos Defense.
That is an incredibly competitive field. So given that, the obvious next question is, how does a microcap like ZenaTech even begin to build a defensible competitive moat? What are the key regulatory hurdles, those barriers to entry, and how are they navigating them?
Yeah, building a competitive advantage as a microcap here is definitely challenging. Regulatory hurdles are significant. You need rigorous FAA approvals for commercial applications and even certified flight schools for complex beyond visual line of sight, or BVLS. Missions. That means flying drones where the operator can't physically see them.
Right, that sounds complex.
It is. And ZenaTech is proactively addressing this. They actually acquired an FAA-certified flight school to control that expertise in-house. A key tailwind, and this is particularly relevant now, is the U.S. government's push for NDAA-compliant domestic drones.
Ah, the Made in the USA push for tech.
Exactly. Yeah. This policy prioritizes U.S.-made technology for defense and critical infrastructure. ZenaTech is actively pursuing this opportunity with Green UAS certification. That signifies their drones meet rigorous security and manufacturing standards, potentially opening doors to significant government contracts. And beyond just regulatory navigation, ZenaTech's competitive moat is being built through a few key things. Strategic acquisitions for brand recognition, definitely, proprietary patents for drone design and technology, and this fascinating foray into quantum computing to enhance drone performance.
Quantum computing for drones, how does that even work?
Well, imagine drones processing sensor data exponentially faster, enabling real-time decisions in super complex environments, or optimizing flight paths in ways conventional computing just can't manage. It's a significant, though, still nascent and unproven differentiator. But it could be a game changer down the line. The roll-up strategy, which means acquiring lots of smaller companies offering fragmented manual services, is designed to consolidate these workflows. They're aiming for economies of scale and creating significant switching costs for customers, kind of like how Uber consolidated and disrupted the taxi industry.
Okay, let's move into Chapter 2, Management Evaluation. All right, let's turn our attention to the leadership steering this, well, ambitious ship. Dr. Sean Pasley is at the helm. What's his approach to growth? And what does the management's track record tell us about their execution capabilities?
Management's track record, led by CEO Dr. Sean Pasley, it clearly demonstrates a focus on aggressive, revenue-accretive growth. We saw that staggering 503% year-over-year revenue increase in Q2 2025.
Incredible.
Yeah, alongside 6 acquisitions just in the first half of the year. And they're targeting an ambitious goal of 25 by mid-2026.
25 acquisitions, that's fast.
It is. This accelerated pace really highlights a team actively executing its strategy. Dr. Pasley has also been quite transparent about the heavy investment and increased expenses required. He frames this short-term unprofitability as, a necessary step towards what he calls sustainable profitability.
That pace, 25 acquisitions by mid-2026, is undeniably aggressive. But, history is littered with companies that grew too fast and stumbled on integration. So given Dr. Pasley's laser focus on aggressive growth, how is ZenaTech specifically allocating its capital to hit these targets? What's the strategic thinking there, balancing expansion and stability?
Right. Capital allocation is indeed laser-focused on growth. They're investing heavily across several fronts. Scaling operations, integrating these new acquisitions, accelerating drone production. They're tripling their Phoenix square footage for U.S. manufacturing.
Tripling, wow.
Yeah, and funding cutting-edge R&D, including those quantum computing projects and patent acquisitions we mentioned. Mergers and acquisitions are clearly the primary driver. It's definitely a high-risk, high-reward approach. It hinges entirely on management's ability to seamlessly integrate diverse cultures, technologies, and build a truly cohesive, tech-enabled national network. Crucially, ZenaTech currently doesn't pay a dividend. No history of share buybacks either, which is, well, prudent for a high-growth company needing every dollar for expansion. And as you'd expect in this hyper-growth phase, their return on invested capital, ROIC, it's negative, ranging from about -4.7% to -25.0%.
Okay, now for Chapter 3, Financial Analysis. Let's shift focus to the numbers. How does ZenaTech stack up financially, especially being a microcap company?
Well, as of August 26, 2025, ZenaTech has a market capitalization of approximately $161.61 million. Its trailing 12-month, or TTM, revenue is around $3.13 million. Now, while historical revenue was modest, the company has definitely entered a period of explosive growth. They reported that remarkable 503% increase in Q2 2025 revenue year over year and a 251% increase for the first 6 months.
That growth sounds genuinely impressive, suggesting incredible traction. But the critical question for any investor is, are they profitable yet? Growth is fantastic, but it doesn't always equal the bottom line, does it?
You're absolutely right. Growth doesn't always equal profit, especially not at this stage. ZenaTech is not yet profitable. While its gross margin is an impressive 100% basically, the cost of goods sold is almost zero for its software and services.
100% gross margin. That's amazing.
It is, but its net profit margin is deeply negative at negative 338.84%.
Minus 338%.
Yeah. That stark difference indicates that operating expenses, heavily driven by their aggressive growth and acquisition strategy, are just far outpacing revenue right now. They also have negative free cash flow, burning about -$9.19 million TTM, which, as we discussed, is pretty common for a company in hyper-growth mode. It's almost like a rocket burning enormous amounts of fuel during launch, necessary but definitely precarious.
Okay, so what assurances does ZenaTech's balance sheet offer? Do they have enough fuel in the tank to actually reach orbit given these burn rates? What does their financial stability look like?
Their balance sheet is absolutely key here, you're right to ask. With a debt-to-equity ratio of 58.5%, it shows, a moderate and seemingly manageable use of debt. More importantly, they boast a strong current ratio of 6.78 and a robust cash reserve of $10.29 million as of June 30, 2025.
Okay, $10 million in cash.
Right. That cash position is more than sufficient to cover their short-term liabilities. It gives them the necessary liquidity to fund these ambitious growth plans despite the current unprofitability and cash burn.
Given they aren't profitable, traditional valuation metrics can be pretty misleading. So how do we even begin to value a company like ZenaTech, especially thinking about its future potential?
Yeah, exactly. For a high-growth, unprofitable company, traditional price-to-earnings, or PE, ratios aren't really meaningful. ZenaTech is negative. A more relevant metric is the price-to-sales, or PS ratio. That currently stands at 25.08.
25 times sales, that's high.
It is quite high relative to peers, yeah. It strongly suggests the market is valuing them at a significant premium for their future potential. While a discounted cash flow, or DCF model, would be heavily dependent on, well, a lot of future assumptions. It's notable that a single analyst has issued a strong buy rating with a $9 price target. That implies significant potential upside from current levels. Ultimately, the true value here really hinges on management's ability to successfully execute that ambitious growth strategy.
Okay, we've just navigated through ZenaTech's business model, assessed their leadership, and dissected their financials in part one. Now let's pivot to part two of our deep dive. We'll explore how the market is perceiving them, delve into who owns a piece of the pie, identify the critical risks on the horizon, and finally, synthesize it all into a concluding outlook. Kicking off part two, we move to chapter 4. Market sentiment. Okay, it seems the market has a bit of a split personality when it comes to ZenaTech. What's the general perception out there? What's driving these contrasting views?
Market sentiment is indeed a fascinating study in contrasts. On one hand, you have that single analyst with strong buy rating and a $9 price target, suggesting over 84% upside from the current price. Recent news has also consistently highlighted their record Q2 revenue, the strategic acquisitions, tech advancements, lots of positive signals. However, this optimism is counterbalanced by a moderately high short interest, sitting at 5.95% of the float.
Okay, almost 6% short. Not insignificant.
Not at all. And what's truly intriguing, maybe even alarming to some, is the extremely high cost to borrow shares, 170.34%.
Wow, 170% borrow cost. That's astronomical.
It is. This creates a compelling and contradictory narrative. You have a significant segment of the market clearly seeing substantial risks, while others, like that analyst, see massive potential.
That combination, high short interest and those astronomical borrowing costs, often signals extreme volatility, doesn't it? Creates a very dynamic situation. What are the technical indicators telling us about ZenaTech's stock movement?
Well, the stock's technical indicators actually suggest a generally positive trend. It's currently operating within a rising trend channel in the medium-long term, according to the report, and there's a healthy positive correlation between price and volume, which is usually seen as constructive. But those high short borrow fees and the moderate short interest are definitely metrics to monitor very closely. They can absolutely lead to significant brief volatility. And, there's the potential for a short squeeze if any robust positive news emerges, forcing those short sellers to cover their positions quickly.
Okay, next up, let's turn to chapter 5. Ownership structure. For a high-growth, potentially volatile company like ZenaTech, understanding who holds the cards can be incredibly telling. What does the stakeholder analysis reveal about the commitment of institutional investors and insiders? And what should we make of that noted lack of recent insider trading activity? That seems a bit odd.
Yeah, ZenaTech's ownership is divided among institutional investors, insiders, and the public. As of June 30, 2025, institutional holdings were 7.91% of shares outstanding. This includes some pretty major names: DNB Asset Management, National Bank of Canada, Morgan Stanley, BlackRock.
Okay, so sophisticated players are involved.
Exactly. It indicates the company is certainly on the radar of sophisticated institutional players. Insiders, crucial for long-term alignment, hold a significant 16.40%. That's a good chunk. However, what's genuinely intriguing, as you pointed out, is the lack of recent insider trading activity specifically. No open market buys or sells in the last 12 months.
Yeah, that is unusual for such a dynamic stock, isn't it? That lack of insider trading. It is genuinely thought-provoking. What are the various ways to interpret that, especially for potential investors? Does it suggest like unwavering confidence where insiders are just holding tight? Or maybe a more cautious approach where they're neither actively buying nor selling into the volatility?
That's a great question, and honestly, there are a few ways to interpret it. On one hand, it could signal that insiders are content with their current holdings. They might view the stock's trajectory as stable or poised for future appreciation, so they don't feel the need to sell. It could also suggest, a quiet confidence in the long-term strategy without needing to signal short-term optimism with pies. On the other hand, for a microcap with such a high growth profile, you might expect active buying if insiders truly believe the stock was undervalued today. The absence of selling does remove one major concern, though. It suggests they aren't actively cashing out. So it's a bit of a nuanced signal, not overtly bullish or bearish, but certainly indicating a holding pattern for now. Overall, the company has a somewhat concentrated ownership structure. Combined insider and institutional holdings are about 24% of outstanding shares. The public holds almost 50%, which indicates a relatively high float for a company of this size. And that high float can definitely contribute to price volatility.
Now for Chapter 6, Risk Assessment, SWOT Analysis. All right, no deep dive is complete without a thorough risk assessment. Let's run ZenaTech through a classic SWOT: strengths, weaknesses, opportunities, and threats. Starting with strengths, what are its core advantages? What's working well?
Okay, strengths. The primary one is its exceptional top-line growth. That over 500% revenue increase in Q2 2025 clearly shows significant DaaS traction. That model is working. Their aggressive acquisition strategy, targeting those 25 companies, is presented as a strategic strength aimed at rapidly gaining market share and building recurring revenue streams. Their sharp focus on the rapidly growing U.S. defense drone market, that's a big plus. And finally, their proprietary technology, including patents, and that foray into quantum computing for drones. Those are key strengths that could differentiate them.
Okay, and what about the flip side? What are the most significant weaknesses ZenaTech is contending with right now? Where are the vulnerabilities?
Well, a major weakness is undeniably its current unprofitability and that persistent negative cash flow. It's a big one. The company is operating at a significant loss, burning cash, which means it relies heavily on its existing balance sheet and presumably future financing to sustain operations. Furthermore, that aggressive pace of acquisitions, while a strength for growth potential, also presents substantial operational and financial risks. Integration challenges combining different cultures, tech, systems. It's never easy.
Very true.
And finally, the stock's volatile nature, which is just typical of microcaps, is another inherent weakness for investors perhaps seeking more stability.
This brings us to a crucial point. Given these weaknesses, what compelling opportunities are still on the table for ZenaTech? What can they leverage to accelerate growth despite the challenges?
Despite the weaknesses, the opportunities are substantial. Both the commercial and defense drone markets are projected for significant, sustained growth for years. That provides a very long runway for expansion. Favorable U.S. government policy directives that push for domestic drone manufacturing, easing certification processes, create direct tailwinds ZenaTech is actively pursuing.
Right, they seem well positioned there.
They do. And as we discussed, their investments in new tech like AI and quantum computing could, potentially, unlock entirely new markets and provide a formidable technological edge over competitors down the road.
Finally, what are the external threats they need to watch out for? Those factors largely outside of management's direct control.
Well, ZenaTech operates in a highly competitive market. They face rivals ranging from massive defense contractors to really agile tech startups. Competition is fierce. Macroeconomic factors like higher interest rates could make financing future growth more expensive. That could potentially impact their ambitious acquisition strategy, though the report didn't explicitly detail this as a current major issue.
Something to watch, though.
Definitely. And geopolitical factors, like the ongoing U.S.-China trade tensions, tariffs on Chinese and even Indian drones, that could disrupt global supply chains, potentially raising component costs, even as they aim for more domestic manufacturing.
We've covered a tremendous amount of ground today, really peeling back the layers on ZenaTech. Let's synthesize our findings and bring it home in Chapter 7. Conclusion. What's the core bull case and the core bear case for ZenaTech boiled down to their essence?
Okay, the bull case for ZenaTech really hinges on its explosive high-growth potential and strategic market positioning. It's fueled by that rapidly expanding DaaS segment and the ambitious roll-up acquisition strategy. Its sharp focus on the government-backed defense sector and that currently healthy balance sheet provide a strong long-term narrative for significant value creation. That's the optimistic view. Conversely, the bear case is rooted in equally significant risks. The current unprofitability and persistent cash burn, first and foremost. Then there are the substantial execution and integration challenges inherent in those aggressive acquisitions, intense competition from well-established players, and of course exposure to broader macroeconomic and geopolitical factors.
So, given all these highly dynamic, often conflicting moving parts, how do we even begin to conceptualize the valuation for a company like ZenaTech? It seems tricky.
It is tricky. The market is unequivocally valuing ZenaTech based on future growth potential. That negative PE ratio makes that clear. However, that analyst consensus price target of $9 suggests a significant intrinsic value upside from where it stands today. This wide gap between the current price and analyst expectations is really a direct reflection of the company's undeniably high risk, yet potentially high reward profile. It captures that tension perfectly.
So, if we connect all these dots to the bigger picture, what's our concluding outlook for ZenaTech? For our listeners, what's the ultimate takeaway from this deep dive?
ZenaTech truly represents a classic high-risk, high-reward investment opportunity. There's really no other way to put it. It demands a significant leap of confidence in management's vision and, critically, their ability to execute an incredibly ambitious roll-up strategy in a rapidly evolving, technically complex market. The company's strategic positioning in these lucrative drone markets, its focus on diversified, recurring revenue streams. That provides a compelling narrative for long-term growth. However, this is crucially balanced by those significant risks: unprofitability, ongoing cash burn, intense competition. Ultimately, the investment thesis hinges entirely on one central question. Can management successfully transform ZenaTech from this collection of disparate acquisitions into a cohesive, profitable, and truly market-leading enterprise? That's the challenge, and that's the opportunity.
As you consider ZenaTech's journey, maybe think about this. If every groundbreaking innovation started with heavy investment and, uncertain profitability, where do we draw the line between a necessary transformative growth phase and just a speculative gamble? What level of risk are you personally willing to embrace for the potential of true market disruption? Something to chew on.
And just a reminder, this analysis was generated by an AI system for educational purposes only. It should absolutely not be considered financial advice. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. If you found this deep dive valuable, please do like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority deep dives on tickers just like ZenaTech. Over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those reports. If you'd like a one-off deep dive on a specific stock, just drop us a super thanks. We really appreciate you joining us on the deep dive, and we'll catch you on the next one.